So good evening, and thank you for being a very patient audience. Um, this is the last session of the day, and we've got a really powerful panel here of investors. Okay, so I've been put in my place. I think what we want to explore today is that everyone talks about this funding winter and the world has changed, and we just want to dissect it in terms of what has happened, why it has happened, and what's the implication for investments, for founders and their startups, right? So let me start with the big macro question. You know, everyone was having a party, right? What happened? What changed?
Yeah, everyone was having quite the party. I think we're back to maybe where we were closer in 2018, 2019. And at some level, I think the last couple of years were perhaps a bit of an aberration. But that being said, I think it's still a very interesting time to think about businesses from a more sustainable lens. And obviously, you know, investments have adjusted accordingly. If I was to take a stage lens, Ashish, you know, there is early, there is growth, there is late stage. We are at least seeing a bit of a dumbbell shape to deal flow. So I think the early stage still tends to be reasonably vibrant. We're seeing a reasonable amount of action at the late stage, controlled transactions, private equity. But I think it is that middle layer of traditional growth, you know, that 10 to 20 million check size, where I think there has been some slowing.
I think after the party, the hangover always comes. And that's what we saw. But I went to school in Nainital where we had this song saying with every winter, there's the promise of spring. And I think we're beginning to see the offshoots of spring, and especially in early stage. So I think none of this lasts for too long. Clearly, when things go irrational, just like a boiling pot of water, it has to cool down. You have to turn off the flame. And that's really what happened. And this is going to continue to happen. It's just, in my view, the seasonal change has become shorter. So if I recall, April 20 to September 20, it was like pencils down and gloom and doom. And then we had the biggest party, and then it was gloom and doom. So the cycle seemed to be getting shorter. But it's just the law of economics, I would say.
That's very well said.
Look, I think the party ran much longer than what it should have. It ran for almost 10 years, and cycles always come in. Business cycles happen all the time, and I think a lot of us were predicting that the party will stop sooner. It just went on for a couple of years longer, but I think it's a great time to be actually making investments, and I think for this panel in particular, it's an opportunity to really introspect, look at good business models, look at great entrepreneurs, and deals are being done at valuations which will really be attractive in the next 3, 4, 5 years. And if you look back, you know, if you see what are the correlation between fund returns, I think the vintage has a big correlation. So this vintage actually is going to be a great vintage for investing, whether it's 23, 24. So I think the folks who have raised capital, who are sitting on dry powder, who are ready to write checks and be a little more courageous, because I think when the winter comes, I think everyone gets cold feet. So I think people who can have some conviction and write checks at this time, this vintage I think is going to be a great one in hindsight.
That's a pretty good hint for LPs in the room, but I hope they take it.
Good evening, everybody. So I'm just thinking about, like, you know, what creates the party, right? First, there's supply of capital party, and then there is supply of startups party, right? Like, so it's both. And the last 2 years saw a kind of a convergence of the two, where you also saw early 2010s, for example, if you look at the digital story, it was like quite sad, wasn't it? And then you had the Flipkarts and like all the payment companies, etc., come and kind of create a boom after that. So you had then you had supply of startups. Earlier you had supply of capital. So it went up and down. And then in the last 2 years, suddenly the two converged because there was this shift, which which was caused by external factors. And then you saw the markets going really on a very high pace as such. So it was something that is actually going to shift the way that actually what are kind of companies which are going to come out in the next decade, and that I think is a great shift to have happened, right? Where it's no longer going to be. India is very different from what the global stage is. Currently, if you look at the way that things are evolving, it looks like there is quite a bit of local technology. There's a global story. So you're kind of seeing business models and maturity of entrepreneurs in a very different kind of way and a different kind of scale. And in the last 10 years, there have also been a few exits that have happened, which again is a great story for the ecosystem as such. So I agree with what you said in terms of it's a great time to be investing because you have the supply of entrepreneurs and you have the supply of capital. It's just that right now you're calibrating well to say that, look at business models a little bit more. And that sanity was bound to prevail at some point in time.
Siddharth?
Good evening. So I agree with what most people have said. I think the party continued for too long, and it was a much-needed correction in the market. That being said, most of the VCs had a great run in terms of exits over the last 3 or 4 years, so that was very welcome. But again, there was too much capital, and that capital was being invested not with the highest levels of risk underwriting, I would say. Actually, I think now, and we heard it in the last panel as well, that the whole industry has matured. And it has kind of sobered up in many ways. So, LPs and GPs have become a lot more sophisticated over the last few years and are, picking their bets more carefully, which is great for the ecosystem. So I agree with Vish in terms of the next few years being a great vintage. From our standpoint as GPs, I believe valuations are going to be much more attractive and reasonable, sensible. We will back more sensible businesses as well. And the macro situation in India is in a sweet spot, so as we all know. So I think it's going to be a good few years in the cycle.
So that's interesting. I mean, people call it the winter, but I think this panel is generally optimistic because it seems like it's good that that party was over. It was a bubble, if you like. And the story of the India story and the startup story is pretty strong. And therefore, it's probably one of the better times to invest. And that's a pretty good and clear takeaway from the first question. But let's go back to how investing or investing strategies individually have changed because of this shift in the funding environment. And you spoke about a dumbbell-shaped, which means that some of the latest or growth stage deals that were taken for granted at pretty high valuations are no longer taken for granted, right? So if that is the case, and at the same time, there is fair amount of entrepreneur and, sort of tailwinds, how have you all individually adjusted your investment strategies for the next couple of years?
Great question. I think the one major shift has been, I think a change in inbound velocity versus, I think, outbound teamwork. I think during that, during the 2020 to 2022 era, there was just a lot of velocity of inbound deal flow that came in. I think what we're doing now is, I think, taking a 5, 7, 8 year forward view on sectors that we have a lot of conviction in and customer needs that are very, very specific. So it's a lot more outbound, a lot more thematic, I think grounded in end customer requirements and trying to see what in the ecosystem fits in well there. From a fund construct perspective, we have the flexibility to do venture and growth, and we're trying to maintain a balance of both because venture gives us, the hold period, the attractive return profile, but growth gives us line of sight into distributions, more predictable returns. And so we're maintaining that balance, to some extent. In terms of valuations, look, candidly, I think, we have a hold period that is, reasonably long. And so as a result, I don't think we're very influenced by the valuation of today, right? At some level, I think we do look at a 5-year moving average valuation. We think about our exit pricing, keeping that in mind. And then we work backwards and see, look, given the stage, given the sector, is this an appropriate entry valuation? So it's not necessarily very pegged to the here and now multiple of today, nor was it even 2 years ago.
So I think we are seeing sobriety in expectations of both founders in terms of valuation. They're willing to have detailed discussions on their business plan. They're not taking every piece of discussion personally. It's actually more collaborative. So we are seeing a temperament change. I just don't know how permanent it is. The other thing, in addition to strategy, is the process, strengthening and robust process. I do recall hearing news that term sheets were getting signed and process was getting over in 4 weeks and things like that. I think there's much more rigor to the process. It's taking more time. I think funds are not getting caught up by FOMO as much. If the scene is, hey, someone else is coming in 2 weeks, we do it in 2 weeks, that's few and far between. I think also corporate governance is a big area of focus, especially with the sort of emphasis on it in the last year. I think sustainable unit economics, maybe because we are early stage, so most of our companies aren't profitable when we invest in them, but we really want to see a pathway to get there. So we spend a lot more time on the business plan, problem solving, collaborating even before the deal is done. So in addition to valuation, which I think Ashish, you spoke a lot about, and proactive reach outs on thesis, I think process itself has seen a change, which again is good because at least we've always been fundamental investors.
So no, that's interesting, and I think you represented exclusively the early stage side of things. And in a way, the questions that you talk about or the deeper investigation of during the process, would you say that, and you are always been a thoughtful investor, I know that, but do you think it's what the entire early stage ecosystem is asking more questions on unit economics, path to profit? Is that a general rule now, or you think that's still a little bit...
Much more, because it was being done out of hurry and FOMO and let's do it, someone else is coming in, blah, blah, blah. Now it's like, hey, we got to have an independent point of view. It will take as long as it takes, so you just have more time. And I think everyone always knows the process. It's the discipline with which they follow the process. That's always the case.
Vish?
Yeah, in terms of our strategy, I think we do a little more later stage growth investing. And I think the one change that we are seeing is that there are a lot of roll-up opportunities that are available. There are many companies that were initially trying to do everything in a particular subspace. And now, I think with scarcity of capital, with the benefit of hindsight and introspection, I think a lot of them are saying, can we collaborate? Can we work together to combine and be a stronger company? So in a lot of our companies, we are seeing opportunities for roll-up. And I think we're just in the middle of a big acquisition on one of our portfolio companies. So I think we'll see, instead of having 20 companies in health tech and 20 companies in fintech, edtech, et cetera, there's going to be consolidation, right? And then the strongest will survive, but the guys who combine together and find that the combined entity may be actually more valuable could be interesting. So we are spending a lot more time looking at some of those roll-ups. And historically as well, if you look at the last recession, there's been a lot of that activity. So, and even independently, I think tech buyouts is going to become a big focus area. So you're seeing some companies already, PharmEasy is an example where it's a large company, they do $1.8 billion of revenue, right? They raised a lot of capital, but for a variety of reasons, which we don't need to discuss here, the founders have got diluted. There are some investors looking to come in and take a large stake, and that may happen with multiple other businesses, right? So there will be situations where many founders will get diluted down, and funds will come in and take large positions. So tech buyouts haven't happened in India. They've happened outside. But I think it's an opportunity in the next 2-3 years for that asset class to get built up.
So there's a good side where there's an aggregation opportunity, but you're also saying that someone has to pay for the party, right?
Yeah, you have to pay less for the party, but yes, you have to pay. And I think in many ways, to be honest, a lot of these founders are very young guys, right? They were 29, 30, 32. They were entrusted with hundreds of millions of dollars, right? Without, frankly, too many questions being asked about how to spend that money. So frankly, the fault cannot be attributed only to the entrepreneurs. It's also on this side of the table, where if you give $500 million to a 30-year-old guy and tell him the only metric that matters is revenue, the outcome is going to be what we are seeing now. So it's not something which is, could not have been predicted, right? But now that we are where we are, I think there are many people on the various parts of the cap table, including buyout funds that can come in and take significant positions. Frankly, many of these companies are good companies with a lot of good bones around them. It's just that maybe the cap table needs to change, maybe the management needs to be augmented, but there's an opportunity to build maybe not 100 unicorns, but 20 sustainable unicorns.
Actually, I just want to go back to the point that you made in the last conversation. We sit in that space which is the B, right? And what you alluded to as a white space, where there's still opportunity at the late stage and there's still opportunity at the earlier stage. Well, we sit in between. And in that kind of a context, we are seeing much more the inbounds now. And there is a lot of receptivity, if you will, to as you were mentioning, the longer conversations as such. But in general, we are also seeing that there is depth in markets in terms of themes and theses that can get funded, right? So to be thoughtful, to build expertise, to build actually value, and to be able to do some of the things that you were saying in terms of the roll-ups, for example, you need to have that deal flow coming in for you, and you need to know what the markets are doing, right? So the expertise and the networks that we kind of build are in that kind of a fashion. So you asked what changed for us, right? Investing remains more or less similar, but in terms of what we can work through with portfolio companies, a lot is changing, right? There is one part of it is for us, financial services is a large part of our portfolio. So working with regulatory bodies is actually an important skill that you kind of bring, right? So that we bring in that kind of an expertise. So our networks in that area have gone up, right? And the second part of it is in terms of bringing in, the strengths of multiple business models without actually the excesses part of it, right? So how do you do the roll-ups where valuations are always a sticky part of the equation? So that's the second part that we're actually seeing quite a bit of, our time being spent. So if you look at what we are doing, we are investing and we are also spending equally quite a bit of time with our portfolio organizations. And that part of earlier where every 3 months you got a term sheet and therefore you didn't spend too much time with your investors is also disappearing. So that's a very good development in our point of view, which actually points to a much more stable, robust, calibrated strategy that many people are following.
That's Siddharth.
Yeah, so we're typically growth capital investors, very traditional growth capital investors. And while we have done some late venture investments over the last few years, we're reverting to sort of the more later stage deals now from a portfolio construction standpoint. I think from our perspective, deals are taking longer to close. To your point, there's a lot more due diligence that we're doing from a governance standpoint, but also the financial sustainability standpoint, which we sort of ignored a few years ago. So capital efficiency and the history of capital efficiency is become very critical in our evaluation. And we're also looking to get comfort and to build confidence in the future in terms of, are these businesses going to be sustainable from a capital efficiency standpoint or capital return metric standpoint in the future, even if they're not profitable today. So a lot more effort is going into evaluating those metrics. And then, I think, as Vish said, we were backing a lot of young entrepreneurs, with probably less experience in financial controls. And I think one of the key learnings that we've had is having a strong finance team, CFO, controller, whatever you call it, on day one. And enhancing that sort of capability from the start, because the founder themselves don't necessarily have all the skill sets. So I think that's become more important as we look at the teams we're backing, and I think it gets too late if you don't do that from day one. So I think that's one of the other considerations that we've been focusing on as well.
So, moving on, I think one of the things that, I think some of you mentioned is that the supply of new ventures is fairly robust. And at the same time, you're still seeing a lot of new areas and new technologies coming. The India story is robust, and all kinds of new sectors, from defense to semicon to space, everything seems emerging, right? So personally, and I think health is a big space for the two of you. So what are your favorite themes now? And that's something that I think everyone loves to hear about, as to what is keeping you, what are the themes? And you mentioned outbound thematic. What are the things that you're really excited about in healthcare?
Yeah, I spend a bunch of time in healthcare and life sciences. I think, what really excites me at the earlier stage is, for the first time, we're seeing, the emergence of I would say, an innovation ecosystem. What I mean by that is biotech companies, data sciences, health tech companies, etc., building truly innovative product solutions in India, either for India or for the world. I think, that's an interesting one. An area we built, I think, a thesis on, and we've, I think, backed that through with a number of investments, is cross-border healthcare technology. Along, I would say, the India-US corridor as being one. We've made a number of investments in the last 3 or 4 years, solving for fairly large addressable market problems in global markets, right? I mean, these are several billion-dollar issues. It could range from simplistic workflow automation to fairly sophisticated, use of data sciences, artificial intelligence. And I think more broadly, while as a community we are talking about a slowing tempo of the investment climate, I think the external market itself is as vibrant as it's ever been, or probably more so, right? I mean, if you look at just the pace of technology evolution, you look at, what we're seeing on Gen AI, on advanced data sciences, on, clean energy, on, so many different areas. I think we're seeing that India is very close to the cutting edge of a lot of these areas. And there is a talent base here that has global exposure, leveraging the local strengths to solve for those problems. So I think we're really taking a very forward-looking view on a lot of our early-stage investments from a theme perspective.
I'll just build, because Ashish, you guys sort of follow us in many cases, given our ticket size. Look, healthcare is so exciting. I mean, everyone needs healthcare. If the economy is growing at 7%, healthcare is growing at 15%. Every person sitting here will need healthcare before, when you're born, when you're going to die. I'm sorry to be sort of morose. So healthcare is exciting. What makes healthcare exciting in India is actually some of the basic problems around affordability. So if any company can make the product or service lower cost, if they can make it more accessible, if they can make it more higher quality, if they can increase the clinical outcome, whatever be the area, we are interested. So we're really solving for the consumer, the end consumer, and the intermediaries, of course, in business. If you have a value proposition like that for any company in that space, it's going to be a winner, and that's how we see it. So back to fundamentals, we really look at the fundamental problem the company is solving, and if it's really around these 4 or 5 parameters, we think in the long run it'll win.
So I'll say 2 things. Number one, I think what everyone is saying is that the supply of good companies and entrepreneurs, I think it's as good as ever that I've seen, right? So if you look at 1991 when reforms happened, right, where some of us on the panel that were in college and school at that time, remember the times when you had to wait for a phone connection, you had to wait for a gas connection, you had to wait for that Bajaj Chetak, even an Air India ticket needed to be kuch sifarish se hi milti thi, right? So this generation now born after 91 doesn't know any of that, right? There is no memory of that age where risk-taking was not permitted or was not something which was encouraged, right? Now, when we were graduating from college, the best jobs were McKinsey, Goldman. Now these kids are coming out and dreaming of a startup, right? So I think once that genie has come out of the bottle, it cannot be put back in, right? So I think that's the good news, where young, smart, dynamic people are looking to innovate, looking to build good companies. So I think in that sense, deal flow is good and will continue to be good, right? In terms of the spaces, I think what we are focused on is, you mentioned the India-US corridor. We are focused on the India-GCC corridor. And I think both areas are regions cash-rich. India has a lot of supply of good talent. There's a lot of supply of good capital. And I think the GCC in particular wants to encourage homegrown companies. So historically, many of us here used to show up in Abu Dhabi and Riyadh asking for capital, right? But what they want is not to roll out capital alone, but to encourage their own ecosystem. So they want companies to be based in Abu Dhabi, in Riyadh, in these geographies, and build their own ecosystem. So I think GPs who are focusing on that, I think there's a lot of capital. And a lot of Indian companies, frankly, unit economics of these businesses are much better in these markets. So it's a natural extension of building their businesses. The next stage of building their businesses could very well be in these markets. So that's the opportunity we are focused on. And I think over the next 5-10 years, there's going to be many unicorns, many companies focused on that strategy.
Excellent.
So the 3 things actually, I'd like to state before we get to the themes that we're looking at. One is that India is going over a shift, right? In the sense that we're moving to becoming a middle-income country as such. That by itself suddenly changes and creates a lot of opportunity. As you were mentioning, I think there are enough number of macroeconomic tailwinds that are pushing that story ahead. And in that kind of a context, there's the way that for every institution, that institutions need to shift, what needs to happen for delivery of regular services like healthcare, like banking, like education, etc. Actually, is going to shift very deeply, right? So as we are thinking forward, that's one shift that we want to plug into, right? That's one. The second is there is deep degree of self-sustenance in the conversations that are happening around, which is about India as an economy sustaining itself. It's not only India, I think even globally that story is playing out, where because of COVID and the disruption in supply chains, people are thinking about how do I localize more, right? And that's a localization manufacturing story that's playing out big time. The third is the China plus one, as people call it, right? There is also that part of it, which is if not China, then where? And geopolitical reasons are actually beginning to focus on markets which can deliver as such. So there's some of these kind of trends that we actually are following. If you look at our funds, actually, our capabilities lie in financial services. Much of our last fund is in financial services as such. That continues to play into these themes, right? Especially when you're looking at becoming a middle-income country, there is a lot of need for capital, and there is a lot of need for managing capital as well. So that's one theme which continues to play a big role. But the other theme that we're increasingly beginning to look through is actually around the, how do you build out capabilities in the industrials, if you will, which is B2B businesses, manufacturing, and so on and so forth. And that's an area that we're beginning to focus on. Having said that, there's also a question of like, it's a fund with a limited life, right? Like, so we need to find businesses which we also can exit within like a foreseeable time frame. Maybe 6 to 8 years is actually our holding period and so on. So in that kind of a context, like financial services and, like IT related, if you will, tech related ends up being still a big focus. So there's a convergence there also which is happening, and that's a theme that we are following quite closely, which is the overlap between banking infrastructure, as we're calling it, banking and IT infrastructure, business and IT infrastructure, right? Like, so that's a big theme that we're beginning to follow through as such.
So we are focusing broadly on 3 themes at the moment. One is healthcare. I think we share a lot of the same sentiments about the future of healthcare. Within healthcare, we are looking specifically at tier 2, tier 3, tier 4 healthcare infrastructure around services and delivery. Traditionally, hospitals in these areas have not been, there hasn't been enough infrastructure built, and we see a huge opportunity for brownfield expansion of branded hospitals. So we're looking at that space very seriously. Also, health insurance. If you look at the push from the IRDA and insurance for all by 2047, a huge amount of tailwinds, positive regulations, and progressive policies. So health insurance, just given the underpenetration today, is a sector of huge interest, and we're looking at traditional players, insurtech players, both on the manufacturing side as well as distribution side. And then the 2 other broad themes, we've always been focused on financial services as well. We think, if anyone was at GFF last week, you could sense the level of excitement, energy, pace of innovation in the fintech ecosystem. I think it's going to be a very good credit cycle, personally, over the next few years. Again, huge underpenetration across products, asset management, insurance, and credit, and housing, finance, etc. So we are looking at various themes within financial services. And then the last theme is broadly manufacturing. We talked about China Plus One and other government initiatives like PLI schemes. You're seeing private capex increase now over the last few quarters. I think given the macro tailwinds, we're going to see that rising over the next few years. So lots of interesting manufacturing businesses that are export-led will become very attractive. So that's another theme we're looking at.
No, great. This has been very insightful. We have run out of time, but I'll just try to summarize what all you have contributed. I think, personally, I did not see any winter out here. It seems to be fairly warm where we are sitting. It's definitely spring. If it's not, it's not really scorching heat, but certainly spring. Lots of themes from healthcare, financial services, tech-related, hospitals, more traditional, India growth in general, and also emerging tech. We did hear, of course, that there's more time being spent on diligence, more caution, and perhaps more sensible valuations. And I think the other part which we didn't spend time on is focus on governance and focus on getting your portfolio to sort of step up. I think that speaks for a pretty good and optimistic picture. And I certainly know, even as an investor, that it makes our lives a lot easier than be sitting in scorching heat environment. So with that, I think I would like to thank the panelists, and also thanks to the entire lovely audience. You have stayed with us for the entire day. Thank you very much, and I hope you enjoyed this panel. Thank you.
Thank you.
Thank you, panelists, for the amazing strategies. Now I know this is why VCs don't just ride the wave, but create the wave. Let's raise a glass and toast to the future where every investment becomes a dragon.